Welcome to The Deep Dive, the show where we cut through the noise, distill the most important nuggets of knowledge from a stack of sources, and bring you truly well-informed insights. Today, we're diving deep into Airbnb, a company that's, well, more than just the travel platform, isn't it? It's become a global phenomenon.
Absolutely.
And here's the fascinating question we're going to explore. Has Airbnb's very success, the thing that made to Airbnb a verb worldwide, actually created its biggest long-term challenge? Our sources suggest its growth has sparked this fundamental tension between its iconic brand, unique local experiences, and the emerging reality of these large-scale professional hosts.
Right. That's the core paradox we'll be unpacking.
Exactly. By the end of this deep dive, we aim to get a clearer picture. Is this tension just a growing pain manageable, or is it maybe a real crack in the foundation of their competitive advantage, their moat?
That's right. Today's deep dive is into Airbnb, Inc. It trades on the NASDAQ, ticker ABNB, and we're approaching this analysis very much through the lens of value investing. So focusing on the crucial stuff, understanding the business, the management quality, financial health, and of course, trying to get a handle on its intrinsic value.
Okay.
All our data is current as of June 21st, 2025. The stock closed at $131.73 on June 20th.
Got it. So we've structured this deep dive to give you a really comprehensive overview. We'll tackle it in two main parts. Part 1 will lay the groundwork. We'll cover Chapter 1, the business of belonging. Then we'll move into Chapter 2, evaluating the captains of the ship, management and capital. And we'll wrap up Part 1 with Chapter 3, financial analysis.
Okay.
Then in Part 2, we'll shift focus to the bigger picture. We'll dive into Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and finally, we'll bring it all together in our Chapter 7, conclusion. Oh, and before we jump in, just a quick reminder, remember to like and subscribe to Stock Analytics AI.
Please do.
For just $4.99 a month, members get priority deep dives on specific tickers. And over the next few months, we're actually covering all of the S&P 500 stocks exclusively for our members. So definitely check that out.
Great value there.
Right. Okay, let's begin. Let's really understand what makes Airbnb tick. We're starting with Chapter 1, the business of belonging. An analysis of Airbnb's empire. So at its heart, Airbnb is what they call a digital aggregator. What does that actually mean in practice?
Well, it means they don't own the hotels, the rooms, the properties, right? They're a platform connecting two sides of a market. Hosts who have space and guests looking for somewhere to stay.
Okay.
And this asset-light model, not owning the physical stuff, that's absolutely key to their scalability. It lets them expand globally without the huge upfront costs that, say, a hotel chain faces.
Right, no massive building costs. And how does that translate into how they make money?
It flows directly into their revenue model. It's dual-sided. Guests usually pay a service fee, maybe 5% to 15% of the booking subtotal. And hosts generally pay a smaller fee, maybe around 3%. Although, interestingly, for experiences, those curated local activities, the commission jumps quite a bit to 20%.
Wow. Okay.
And there's also this host-only fee structure sometimes where the host pays a larger chunk, maybe 14–16%, which makes the price simpler for the guest to see.
Gotcha. And they've branched out too, haven't they? Beyond just standard stays.
Yeah, strategic expansions, things like Airbnb Plus for verified higher quality homes, Luxe for the really high-end luxury properties, and Airbnb for work, specifically targeting business travelers.
Okay. And the core products then? It's the app and the website, obviously, but what else?
Well, the platform itself is key, that intuitive website and mobile app. Then there's the sheer diversity of places you can book, like you said, rooms, entire homes, but also boats, tree houses, all sorts.
Yeah, some unique stuff.
Definitely. And those experiences, they're really a critical growth area. It's about monetizing the whole trip, not just the bed for the night.
That makes sense. But what about trust? Connecting strangers online, that seems like a huge hurdle. How do they manage that?
That's where their platform tools are so clever. Think about it. Robust search filters, secure payments, where Airbnb actually holds the money until 24 hours after the guest checks in.
Oh, right. That's important.
Very important. Plus private messaging between hosts and guests and that absolutely essential two-way review system.
Yeah, the reviews are huge.
They're everything. These aren't just nice features. They build the community, build the trust. And that's incredibly hard for any newcomer to just replicate overnight.
You can see how that works.
Yeah.
And clearly it has worked, looking at their market position.
Oh, it's formidable. They operate in over 220 countries. The number of active listings is just staggering, somewhere between 5.6 and 7.7 million globally.
Wow.
In the U.S. short-term rental market, they have a commanding 43% share. That's way ahead of Vrbo at 21% or Booking.com at 8%. Europe's a bit different. Booking.com is actually bigger there, with 48% share compared to Airbnb's 40%. But globally, huge scale. In 2024 alone, they processed over 491 million nights and experiences booked,
Incredible numbers.
generating nearly $82 billion in gross booking value. Just massive volume.
So what's the fundamental appeal? Why do guests choose Airbnb and why do hosts list?
For guests, it's often that promise of a unique, authentic experience, right? The chance to live like a local, and frequently it's more affordable, especially if you're traveling in a group.
Makes sense.
For hosts, it's flexible income. They can monetize an asset they already have, maybe a spare room or a second home. They get control over their pricing and availability, plus Airbnb provides tools, 247 support, and that host guarantee program for some peace of mind.
Right. And what about the wider travel market? What trends are helping or maybe hindering Airbnb?
Well, the global travel industry is definitely bouncing back post-pandemic. The online travel market is huge, projected to exceed $800 billion by 2028. We're seeing clear trends favoring them too. People wanting experiences, not just accommodation. The whole workcation or bleisure trend blurring work and leisure travel that fits their model well.
Yeah, remote work changing things.
Exactly. And increasing use of technology, especially AI for personalization, dynamic pricing tools, that's right up their alley.
And competition. You mentioned Booking and Vrbo. How big a threat are they?
They're definitely competition. Booking Holdings and Expedia Group, which owns Vrbo, are massive players. But Airbnb's brand is just such a powerful defense. Our analysis shows, it's mentioned online, like 2.5 times more often than its top 5 competitors combined.
That's amazing.
It's a huge advantage. People don't just search for vacation rentals, they search for Airbnb.
That brand recognition is incredible. Can you break down those competitive advantages a bit more? What really sets them apart?
Sure, first, as you said, brand strength. To Airbnb is a verb, that's gold. And the fact that 90% of their traffic comes directly to their site or app or is unpaid organic search, that's a massive cost saving compared to competitors constantly paying for clicks.
90% direct or unpaid. Wow.
Huge.
Right.
Second, cost advantages and economies of scale. Because they're asset light, they don't have the huge capital costs of building and maintaining hotels. Their costs are mainly tech, marketing, support, things that scale really well as they process more bookings. Efficiency goes up.
Okay. And that famous network effect. How crucial is that?
Oh, it's incredibly powerful. It's that virtuous cycle. More guests attract more hosts because there's demand. More hosts offering more unique places attract more guests. It feeds itself.
A positive feedback loop.
Exactly. And here's a fascinating stat. 36% of new hosts on Airbnb were previously guests, so the platform itself is generating its own supply. It's a powerful organic growth engine. And finally, their unique assets and capabilities. They have this enormous unique data set about travel patterns, preferences, pricing. They use AI and machine learning on this data for personalization, for dynamic pricing tools to help hosts optimize, and just to make the whole platform run more efficiently. That data itself is a moat.
Those are really strong advantages.
Yeah.
But you mentioned headwinds earlier. This brings us to the regulatory environment. Our sources flag this as possibly the single biggest threat. How serious is it?
It is extremely significant. And it's not going away. It seems like an active, persistent headwind. Many city governments, especially in popular tourist destinations, see short-term rentals, or STRs, as a problem.
Why is that?
They argue STRs take housing off the long-term rental market, pushing up rents for locals, exacerbating housing shortages, and sometimes just disrupting the character of residential neighborhoods.
Right. The party house problem or just too many tourists.
Exactly. So regulations pop up everywhere. Things like needing licenses, paying special hotel taxes, zoning restrictions saying where you can operate, and sometimes strict caps limits on the number of nights you can rent per year, or even outright bans in certain areas.
Can you use some examples?
Sure. Think about New York City's really aggressive crackdown in 2023. Austin, Texas, completely overhauled its rules. Honolulu has restricted rentals mainly to specific resort zones. These aren't just one-offs. It's an ongoing battle in city after city, and it directly limits Airbnb's growth potential, especially in those very profitable urban markets.
Okay, so if we pull all this together, the powerful brand, the network effects, the asset-light model, but then it's constant regulatory pressure. What's the core tension here for Airbnb?
It's a really interesting paradox, isn't it? Airbnb built its brand on unique, authentic, local travel, often staying in someone's actual home or spare room.
Right, the original idea.
But its success, its sheer scale, has attracted professional hosts, people or companies managing large portfolios of properties purely as short-term rentals.
Like mini hotels, basically.
Pretty much. In a city like Barcelona, for instance, data suggests something like 74% of Airbnb listings are run by these multi-property hosts.
74%. That's huge.
It is. And that creates this fundamental disconnect. The platform reality is shifting towards these more professional, sometimes less unique, hotel-like operations. This risks diluting the brand, potentially weakening that network effect if guests feel it's losing its charm. It might even mean higher marketing costs down the line if they have to compete more directly with hotels on price and features. And, crucially, it fuels that regulatory backlash because large-scale commercial operations often draw more scrutiny than individuals renting out a room.
So they're walking this tightrope between needing scale and growth and preserving the unique identity that got them there in the first place.
Precisely. It's a constant balancing act.
Okay, that makes sense. Now, a company's direction often comes down to leadership. Let's turn our attention to Chapter 2. Evaluating the captains of the ship. Management and capital. Airbnb is still founder-led, right? Brian Chesky.
Yes, he's still CEO. Many investors see that continuity as a positive.
What's been the biggest test for him and his team so far? How did they handle it?
Without a doubt, it was the COVID-19 pandemic. I mean, their revenues just fell off a cliff, down over 70% almost overnight. Travel just stopped.
Yeah, that must have been terrifying.
Absolutely. But management's response was pretty swift and decisive. They had painful layoffs, about 25% of the workforce. But they also acted to support their hosts, set up a $250 million relief fund. And they quickly launched an enhanced cleaning initiative to rebuild traveler confidence.
Right. Cleanliness became paramount.
Exactly. It showed they could adapt quickly and, crucially, that they understood how vital their host community was. That was key to surviving and then bouncing back so strongly.
So post-pandemic, how are they thinking about using their capital now? What are the priorities?
Their priorities seem quite clear based on what they communicate. Number one is organic growth, investing back into the core platform and user experience. Number two is strategic M&A, though they haven't done huge deals recently. And number three is returning capital to shareholders.
And where's the focus right now within those?
Currently, there seems to be a strong focus on investing beyond the core. They've earmarked about $250 million just for 2025 to develop and scale new services. Experience is a big part of that, and also to push harder on international expansion.
So investing for future growth. What about returning capital?
They've been very aggressive on that front, specifically with share buybacks, billions returned in the last couple of years. Let's see, $2.25 billion in fiscal 23, $3.4 billion in 24, another $807 million just in Q1 of 2025.
Wow, big numbers.
Yeah, and they just announced a new $6 billion buyback authorization. So they're clearly committed to reducing the number of shares outstanding over time. One thing to note, though, they don't pay dividends. All returns are via buybacks or reinvestment.
Okay. And how effectively are they using the capital they do invest? What does return on invested capital, the ROIC, tell us?
Their ROIC is genuinely excellent. On a trailing 12-month basis, depending on the exact calculation, it's somewhere between 22.5% and 28.11%.
And how does that compare?
It's substantially higher than the travel industry median, which is around 11.9%. And it's comfortably above their estimated cost of capital, their WACC, which is around 12.63%. So they're creating significant value with their investments.
Okay.
Although it is worth mentioning, the Q1 2025 ROIC was a bit lower. That's likely due to seasonality, but also those upfront investments they're making in new ventures we talked about.
So if you put the buybacks together with the new venture spending, it feels like they're acting like two different companies almost.
That's a great way to put it. It does create this strategic crossroads feel. On one hand, they're acting like a mature cash-generating machine, returning billions via buybacks, like a value stock.
Yeah.
On the other hand, they're investing heavily in these new, somewhat unproven ventures like experiences, acting more like a high-growth startup looking for the next big thing.
So the investment tension is, can the core business keep funding these potentially risky bets?
Exactly. Can the incredibly profitable core accommodation business generate enough cash to fund these potentially lower margin, higher risk bets in new areas? Management themselves have cautioned about some short-term pressure on margins because of these investments. It's a classic challenge for a successful company. Double down on what works or take big swings for future growth.
A balancing act, for sure. Okay, let's pivot to the hard numbers. Time to unpack Chapter 3. Financial analysis. What did the financials reveal about Airbnb's health and trajectory?
All right, the numbers. First off, market cap is around $85.1 billion, so definitely a large cap stock.
Okay.
Revenue growth, it's really a story of incredible resilience and recovery. Remember that 70% drop in 2020? They bounced back hard. Strong double-digit growth each year since, hitting $11.2 billion in revenue for 2024.
Impressive rebound.
Yeah.
And recently?
Most recent quarter, Q1 2025, revenue was $2.3 billion. That's a 6% year-over-year increase as reported. But they noted it's more like 11% if you adjust for calendar effects, like the timing of Easter. So still growing.
Okay. And what about profitability? Are the margins strong?
Exceptionally strong, particularly the gross margin. It hovers around 83% on a trailing 12-month basis. That's a direct benefit of that asset-light platform model. Not owning the properties means much lower cost of goods sold.
Right, mostly platform costs.
Exactly. Operating margin is also healthy. They're guiding for an adjusted EBITDA margin, which is a proxy for operating profitability of at least 34.5% for the full year 2025.
That sounds pretty good.
It is. Net margin, a bottom line, was a very high 43% in fiscal 24, but that was boosted by some one-time tax benefits. A more normalized figure might be the Q1 2025 net margin, which was still a solid 7%.
Okay, solid profits. But you often hear the cash flow is king. How does Airbnb look there?
What's fascinating here is Airbnb is a cash flow machine. They truly excel. In fiscal 24, they generated $4.5 billion in free cash flow. That's an incredible 40% margin on their revenues.
40% FCF margin. Wow.
It's extraordinary. And Q1 2025, $1.8 billion in free cash flow, which is a 78% margin for that quarter.
How is that even possible?
It's largely due to their negative working capital cycle. Remember how guests pay upfront when they book?
Yeah.
Well, Airbnb holds on to that cash. They only pay the host after the guest checks in, typically 24 hours later.
Yeah.
So they constantly have this pool of customer cash, essentially an interest-free loan, sitting on their balance sheet.
Yeah.
This float massively boosts their cash flow generation and gives them enormous financial flexibility.
That's a powerful dynamic. Okay,
Yep.
So great cash flow. What about overall financial stability? Debt.
They've been consistently profitable on a GAAP basis since 2022, which is good to see after their IPO. Now, their debt-to-equity ratio looks a bit high on the surface, around 2.16. But, and this is crucial, a huge chunk of their liabilities, about $9.2 billion, is labeled funds held on behalf of guests. That's the guest money we just talked about, the float. It's not traditional interest-bearing debt like bank loans or bonds. It's really an operating liability. So their actual balance sheet is very strong.
Oh, okay. That context is important.
Very. Their current ratio, which measures short-term liquidity, is a solid 1.27. So they can comfortably cover their near-term obligations. And as we mentioned, no dividend payment.
Right. So incredibly strong financials, amazing cash flow.
Mm.
But what about the stock's valuation? Is the market paying a premium for all this?
Yes, it seems so. Their trailing 12-month price to earnings, or PE ratio, is currently around 32.8.
And how does that stack up?
Well, it's within its own historical range since going public, but compare it to peers. It's almost identical to Booking Holdings, which is also around 32.5. But it's a significant premium over Expedia Group, which trades at a PE of about 19.3.
So the market sees Airbnb and Booking as the premier growth assets in this space.
That's what the PE ratio suggests, yes. They're pricing in higher expectations for growth compared to Expedia.
Okay. Now, PE is one thing. What about intrinsic value? Did your analysis look at that?
Yes, we used a discounted cash flow, or DCF, model. The basic idea is you forecast the company's future free cash flows, then discount them back to what they're worth today using an appropriate discount rate. It gives you an estimate of the intrinsic value based on those future cash flows.
And what did the model suggest for Airbnb?
Based on a range of assumptions about future revenue growth, operating margins, the discount rate, and a terminal growth rate, our educational DCF model yielded an estimated intrinsic value of approximately $111.71 per share.
Okay, $111.71, and the market price is currently?
$131.73 as of our analysis date. So the DCF model suggests the stock might be trading about 15% above its estimated intrinsic value right now.
15% overvalued, according to that model. So summing up the financials.
The bottom line on financials is Airbnb has exceptionally strong underlying economics, high margins, fantastic cash conversion thanks to that float, a really powerful business model. But The current market valuation appears quite rich. It seems priced for a very optimistic future, perhaps near flawless execution on their growth plans. So investing at this price is essentially a bet that management can deliver on those ambitious goals, navigate the risks, and grow into that valuation. There doesn't seem to be much margin for error priced in.
That's a really clear summary.
Okay.
Let's shift gears then.
Yeah.
That concludes part 1. Now, moving into part 2, let's start with chapter 4, market sentiment. What's the general feeling out there on Wall Street about Airbnb right now?
Well, if you look at the analyst community, it's actually quite divided, maybe even leaning cautious. The overall consensus rating is a hold. The average brokerage recommendation, or ABR, is 2.68 on that 1 to 5 scale, where 1 is strong buy and 5 is sell.
So right in the middle.
Pretty much. And out of 41 analysts covering the stock, 21 rated a hold. The average 12-month price target is also pretty modest, somewhere between $139 and $152 roughly, depending on the source. That only suggests maybe 5% to 15% upside from the current price. Not exactly screaming buy.
A hold consensus and only modest upside suggests some caution. But you said views are dispersed.
Oh, very widely dispersed. While the average target is modest, the range of analyst price targets is huge. It goes from a low of $95 all the way up to $200 per share.
Wow, $95 to $200. That's a massive difference.
It really is. It signals significant disagreement among professionals about where this stock is heading. You've got deep-seated bulls who see huge growth potential and equally entrenched bears likely focused on that valuation risk and the regulatory hurdles.
And does the news flow, the general media tone, reflect this split?
It does, yeah. You see bursts of optimism, often tied to company announcements like their annual summer release of new features and services. That gets positive press. Yeah. But that optimism is consistently tempered by cautionary headlines about maybe slowing travel demand, broader macroeconomic uncertainty, inflation concerns. And we've even seen reports noting significant bearish activity in the options market at times, suggesting some big players are betting on a price decline.
Okay, a mixed bag in the news. What about market indicators, like short interest?
Short interest is worth watching. It stands at 3.79% of the float. That's a meaningful percentage, not extremely high, but it shows there's a decent-sized group of investors actively betting against the stock.
Why would they be shorting?
Likely due to those valuation concerns we discussed and the persistent regulatory risk. With 5.31 days to cover, meaning how long it would take for all shorts to buy back their shares based on average daily volume, there is some potential for a short squeeze if the company delivers unexpectedly strong news.
Okay. And technically, how does the stock chart look?
Technically, the picture is actually quite bullish, which contrasts with the fundamental caution. The stock is currently trading above both its 50-day and 200-day moving averages, both simple and exponential.
And what does that usually signal?
Just generally, trading above key moving averages like that is considered a bullish technical signal. It suggests positive price momentum in both the short-term, 50-day, and the longer-term, 200-day.
So putting chapter 4 together, market sentiment is kind of contradictory.
That's exactly it. There's this fascinating disconnect. You have cautious, fundamental analysis from many analysts highlighting the high valuation, the regulatory risks, the uncertainty around these new ventures.
Right.
But then you have bullish technical signals showing the price has been trending upwards. It really feels like a tug of war between value-focused investors who think it's too expensive and momentum or growth investors who are riding the positive trend. Two different philosophies clashing.
Very interesting dynamic. Okay, let's move on to chapter 5, ownership structure. Who actually owns Airbnb stock?
Well, like most large-cap companies, institutional ownership is dominant. Big investment firms, pension funds, mutual funds, they hold the majority, somewhere between 53% and 80%, depending on the data source.
Any familiar names?
Oh yeah, the usual suspects, the Vanguard Group, BlackRock, State Street. These are huge index fund providers, so Airbnb is likely a core holding in many broad market ETFs and mutual funds. It means it's widely held.
Okay. That makes sense.
Yeah.
But this raises an important question. What about the insiders? The executives, the founders, what are they doing with their own shares?
This is where it gets quite concerning from an investment perspective. While co-founder Brian Chesky is still the largest individual shareholder, there's been a very significant, very consistent, and broad-based trend of selling by top insiders over the last 6 to 12 months.
Selling?
We're talking the CEO, the CFO, the CTO, other co-founders like Joe Gebbia, multiple senior people, and it's not small amounts. Hundreds of millions of dollars worth of shares sold collectively.
Hundreds of millions sold. Any
Right.
buying.
And this is the kicker. Our sources indicate zero recorded open market purchases by these insiders during the same period. It's all been selling. For example, Joe Gebbia sold over $336 million worth, Brian Chesky over $133 million.
Wow, that seems like a major red flag, doesn't it? Consistent, broad selling with no buying.
It's generally considered a bearish signal, yes. When the people who arguably know the company best are consistently selling large amounts of stock and not buying any, it can suggest they believe the stock might be fully valued or perhaps even overvalued. Or maybe they just want diversification, but the breadth and scale here are noteworthy.
Definitely something for investors to consider.
Yeah.
Now, beyond the stock ownership, our sources highlighted another critical ownership shift: the concentration of listings on the platform. What's happening there?
Right, this goes back to that core tension we discussed earlier. There's been a fundamental shift away from Airbnb's original sharing economy roots.
Right.
Individuals renting out a spare room or their primary home occasionally.
Yeah.
The data clearly shows that a growing majority of listings, especially in major cities, are now controlled by professional hosts. These are often businesses managing multiple properties solely as short-term rentals.
We mentioned Barcelona earlier.
Right.
74% multi-property hosts. Is that typical?
It's definitely more pronounced in large urban areas, but the trend is widespread. It signals a move from a peer-to-peer, P2P marketplace, towards more of a business-to-consumer B2C platform. Airbnb is increasingly competing directly with traditional hotels and service departments rather than just facilitating individual sharing.
And the risk there is?
The risk is twofold. First, it potentially alienates guests who came to Airbnb specifically seeking that unique, quirky, live-like-a-local experience if more listings feel standardized and commercial. Second, as we said, it likely increases regulatory scrutiny.
So if we look at these two ownership trends together, the insiders selling stock and the platform supply shifting to professional operators, what's the overall picture?
It paints a potentially concerning picture of misalignment. You have insiders reducing their financial stake, while the nature of the service being offered on their platform is morphing, potentially drifting away from its original unique selling proposition. These trends might be interconnected. Perhaps the shift towards professionalization makes the business more predictable but also more vulnerable to regulation, leading insiders to cash out. It's hard to say definitively, but the combination suggests a potential long-term challenge in maintaining both growth and the core brand appeal that fueled that growth initially, a potential hollowing out, perhaps.
That's a sobering thought. Okay, let's transition to explicitly look at the dangers. Chapter 6, Risk Assessment. Can you give us a quick SWOT analysis? Strengths, weaknesses, opportunities, threats.
Sure. We've touched on most of these. Strengths.
Yeah.
Dominant brand, powerful network effects, that asset-light model driving high margins and cash flow. Really strong foundations.
Okay.
Weaknesses. That regulatory vulnerability is key. The brand reality disconnect we just discussed, their dependence on third-party hosts for their entire inventory, and ongoing trust and safety challenges that occasionally hit the headlines.
Opportunities.
Huge opportunities still. International expansion, particularly in developing markets. Growing those new verticals like experiences to capture more travel spend. And continuing to leverage their data and AI for better personalization and efficiency.
And threats. External ones.
Intense competition from Booking, Expedia, and even Google moving into travel search, the ever-present risk of an economic downturn hitting travel budgets, and just evolving consumer preferences, what travelers want, could change.
Got it. Now, how do broader macroeconomic factors fit in? Inflation, interest rates.
Inflation is kind of a double-edged sword. On one hand, it increases costs for hosts, cleaning, utilities, supplies, which could push nightly rates up and potentially dampen guest demand.
Makes sense.
But on the other hand, inflation might actually incentivize more people to become hosts, looking for extra income to cope with rising living costs. So it could boost supply.
Interesting. What about interest rates?
Interest rates feel like a more direct threat. Higher rates mean higher mortgage costs, particularly for those professional hosts who might be leveraged. That could slow down the growth of new listings, constraining supply.
Okay.
And of course, higher rates can squeeze consumer budgets, potentially reducing discretionary spending on things like travel, so it can hit both supply and demand.
Right. And geopolitical factors.
Yeah.
Our sources mentioned the potential impact of U.S. tariffs introduced in 2025.
Yeah.
How does that play out for Airbnb?
Yeah, it's an interesting angle. Tariffs on imported goods, think furniture, electronics, appliances, directly increase the cost for hosts to set up and maintain their properties.
Oh, furnishing costs.
Exactly. Those higher costs might get passed on to guests through higher nightly rates, making Airbnb less competitive on price. But there's a broader impact, too. Trade tensions and tariffs can sometimes damage the image of brand USA, making the U.S. a less attractive destination for international travelers.
Fewer international tourists coming in.
Precisely. And the sources noted an 11.6% drop in international visitor arrivals to the U.S. back in March 2025, which coincided with rising trade tensions. So it's not just direct costs for hosts, it can impact overall inbound travel demand, which is a key market for Airbnb.
So thinking about all these risks, especially regulation, you mentioned a central paradox earlier. Can you elaborate on that?
Yes, if we connect this all back, it seems Airbnb's biggest external threat, which is regulation, is almost a direct result of its greatest internal strength, its incredibly scalable, successful business model.
How so?
Because when Airbnb rapidly scales up in a city, adding thousands of listings, it inevitably has a noticeable impact on the local housing market, on neighborhoods, on infrastructure. That impact triggers the political and community backlash. That backlash leads to restrictive regulations, and those regulations then limit Airbnb's ability to grow further in that market.
So growth itself creates the conditions that limit future growth.
It appears to be a fundamental, almost permanent feature of operating this kind of business at scale in dense urban environments. It's not a problem they can necessarily solve completely. It's a tension they constantly have to manage. Growth leads to impact. Impact leads to backlash. Backlash limits growth. It's a cycle.
That's a really powerful insight into the core challenge. Okay, let's bring everything we've discussed to a head now in Chapter 7. Conclusion. Let's start by synthesizing the key bullish points. Why might someone be optimistic about investing in Airbnb?
Well, first and foremost, you have that unmatched brand and network. It's a global verb, drives enormous direct traffic, giving it a huge cost advantage and a strong competitive moat. Hard to replicate.
Definitely.
Second, it's an asset-light cash machine. Incredibly efficient model, minimal capital investment needed compared to traditional lodging, generating immense free cash flow.
The float effect.
Exactly. Third, there's still a massive runway for growth, untapped international markets, new verticals like experiences that significantly expand their total addressable market beyond just accommodation. And finally, they've proven their resilience and adaptability. Successfully navigating the existential threat of the pandemic shows strong leadership and a flexible model.
Those are compelling points. Now, conversely, summarize the key bearish arguments. Why might someone be hesitant to invest, especially at the current valuation?
The biggest bear point is arguably that unrelenting regulatory vice. It's unpredictable, it's persistent, it's a direct threat to growth, especially in their most profitable urban markets where caps can really bite.
Right, the permanent headwind.
Then there's significant valuation risk. The stock seems priced for near perfection. Our DCF model suggested it's overvalued, leaving very little margin for safety if they stumble.
Okay.
Third, that combination of heavy insider selling and potential brand dilution from professionalization is worrying. Are insiders cashing out while the platform loses some of its unique appeal? It raises questions.
Yeah, the misalignment.
And lastly, its sensitivity to the macro environment. It's exposed to economic downturns hitting travel, inflation impacting costs and demand, and geopolitical factors like tariffs disrupting travel flows.
Okay, a clear set of pros and cons. So just to reiterate the valuation summary for everyone, our educational DCF model estimated Airbnb's intrinsic value at approximately $111.71 per share.
That's right. And as of June 21, 2025, the share price was $131.73. So trading at a notable premium to that particular estimate of intrinsic value.
And that premium really captures the debate, doesn't it?
It absolutely does. It encapsulates the central tension. An investment in Airbnb today at this price is essentially a bet. It's a bet on management's ability to execute an ambitious multi-year plan to transform the company into this all-encompassing travel platform.
Going beyond the core.
Exactly. And doing so while successfully navigating those substantial and persistent risks, regulation, competition, brand perception, all to justify the current market price. It's a high bar.
So perhaps the final provocative thought for you, our listener, to consider is this. How will Airbnb manage that inherent deep-seated tension between its constant need for scale and growth, the absolute necessity of preserving its unique brand identity, and that relentless pressure from regulators? Can it truly evolve beyond travel without losing the very magic that made it so special in the first place? Something to mull over. Well, that was our deep dive into Airbnb. We hope you found it insightful. Don't forget to like and subscribe to Stock Analytics AI.
It really helps us out.
It does. And remember, members get priority deep dives on individual stocks for just €4.99 a month. We are covering all the S&P 500 stocks exclusively for members over the coming months, so it's a great time to join.
And one final important note, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice.
That's right. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Your capital's at risk. Do your homework.